Okay, let's unpack this. We're diving into a financial titan that, and this is kind of mind-blowing, touches something like 10% of all U.S. bank deposits.
It's an incredible number.
And it has a history that stretches back centuries, even though the company we know today is, relatively young.
That's absolutely right. And for you, the learner, our mission today is to really get into the Bank of America Corporation, or BOFA. We're trying to cut through the massive scale of this organization.
And it is massive. We're talking about the second largest banking institution in the U.S.
Exactly. They're only really competing with giants like JP Morgan Chase and Wells Fargo. And our goal is to understand the incredible complexity that's woven into its history.
When we talk about BOFA, the numbers are almost hard to wrap your head around, but they give so much context. As of 2024, BOFA is managing total assets over $3.26 trillion.
Trillion. It's almost an abstract number.
It really is, and that generates a net income of $27.1 billion a year, and they employ around 213,000 people across the globe. It's a vast financial ecosystem. And, while the name Bank of America that you see everywhere was technically created in a 1998 merger, the historical roots go so much deeper.
All the way back to the post-Revolutionary War era.
That's the one.
Let's talk about the modern identity first, though. The corporate headquarters, the legal side, that's in Charlotte, North Carolina.
Right, which was a very deliberate strategic move that we'll definitely get into later.
But the executive decision-making, all the investment banking, that's firmly planted in Manhattan.
And their physical presence just reinforces how important they are to the system. You've got about 3,700 retail centers and something like 15,000 ATMs all over the country.
It is by definition a systemically important financial institution, one of the big four.
Which basically means if it were to fail, it would pose a significant risk to the entire global financial system. So our challenge is really tracing the origins of this sheer regulatory sensitive power. To understand the colossal entity BOFA is today, you have to recognize it was forged from two completely different, almost ideologically opposed foundations.
We call the dual foundation, and it really reflects the duality of American finance itself.
How so?
You have the established sort of colonial structure on one side, and then the revolutionary immigrant disruptor on the other.
Okay, so let's start with that Easter lineage. This is the oldest, most traditional route dating way back to 1784.
This is where we find the Massachusetts Bank.
Oh.
It was chartered right after the American Revolution, and you can't overstate its significance. It was the first federally chartered joint stock-owned bank in the U.S.
The very first.
Well, only the second to get a U.S. charter at all. So when you trace this lineage, you're tracing a core piece of the birth of American public finance. It really represented the established, politically connected elite of Boston and New England.
So how did that ancient piece of New England history get connected to a bank headquartered in North Carolina?
Well, that's the thing. That history stayed separate for over 2 centuries. It went through a long series of name changes, mergers, acquisitions. It became a big regional player.
And eventually became Fleet Boston Financial.
Exactly. And it was only when Bank of America acquired Fleet Boston in 2004 that this 1784 history formally became part of the modern company. It's just an incredibly long tale of corporate history.
Okay, so let's get to this duality. Because the other route is, like you said, the truly revolutionary one. It fundamentally changed who could even get a bank account.
This is the crucial Western lineage, and it all starts with one person, Amedeo Pietro Giannini in San Francisco. He founded the Bank of Italy on October 17, 1904.
And Gianni wasn't just, starting another bank. He was making a social statement, wasn't he? What was his motivation?
It came from profound necessity and from injustice. Gianni was a child of Italian immigrants, and he saw firsthand that the established English-speaking banks in San Francisco routinely discriminated against them.
And not just Italians, right?
No, other working-class people, non-WASP populations. They were denied loans, denied capital. They were basically seen as too risky for the system. So Giannini built the Bank of Italy, specifically to serve that underserved class immigrants, farmers, small businesses. It was a community institution, first and foremost.
This philosophy must have caught on immediately, but the sources all point to one pivotal moment that really launched the bank into the big leagues.
The 1906 San Francisco earthquake.
Right?
It was tragedy, of course. It destroyed so much of the city, including the entire financial district. Most banks were physically incapacitated or, out of fear. They just refused to pay out claims or offer new loans.
And not Giannini.
No. He famously hauled his bank's assets out of the ruins, literally, in a wooden wagon, and set up a temporary bank on the city docks. He didn't wait for bureaucracy. He started issuing loans to small businesses and homeowners based on a handshake.
Just a handshake.
A handshake and the promise of future insurance money.
That's a fascinating story because it shows how quickly you can build trust in a crisis if you actually commit to the community.
Exactly. This act of immediate public trust just cemented the Bank of Italy's reputation as the people's bank. While other banks were slow, Giannini's bank grew rapidly, distributing insurance payments and financing the rebuilding. His deposit base just exploded.
And once he had that community trust, he turned his focus to strategy, to branch banking.
This was the next disruptive move. At the time, branch banking having multiple offices was restricted or, viewed with a lot of suspicion.
So he had to fight for it.
He lobbied aggressively. He believed the banking system should be accessible to everyone, not centralized in one place. So when California legislation finally allowed branch banking in 1909, he moved fast. The first branch outside San Francisco opened in San Jose that same year.
And that aggressive expansion just paid off exponentially.
It absolutely did. It let him absorb smaller regional banks and serve huge areas. By the end of the Roaring '20s, in 1929, the Bank of Italy had become a financial juggernaut. It had 453 banking offices across California and held over $1.4 billion in resources.
A staggering number for a state bank at that time.
Unheard of.
Which brings us to the consolidation where the Bank of America name finally emerges.
Right, this happened in 2 steps. First, the Bank of America Los Angeles was set up in 1922, and Gianni had a minority stake in it.
Okay.
Then, in 1928, Gianni initiated the big merger. He combined his dominant Bank of Italy with the Bank of America Los Angeles, which was run by a guy named Ora E. Monet.
So it was a marriage of the Northern California giant with a growing Southern California presence.
Precisely. And in 1930, they made the definitive name change, becoming the Bank of America National Trust and Savings Association. This was a critical regulatory move, giving them national status, and Gianni and Monet were co-chairs.
And what's really interesting is that the modern corporation still holds the specific federal charter granted to Gianni's bank.
It's Charter 360-44, granted in 1927. It shows that the revolutionary Western lineage is the direct technical ancestor of today's giant.
So by 1930, Bank of America is a consolidated, massive national bank based in California. But as we move into the mid-century, the federal government starts to get nervous.
Very nervous. They became increasingly worried about this concentration of financial power, and that resulted in decades of regulatory attempts to contain BOPA's scale.
That's really the core theme of this period for them, being constantly restrained by federal regulation. And the first big intervention was about what banks could own.
That's the 1953 separation forced under the Clayton Antitrust Act. Regulators were really concerned about the bank's holding company, Transamerica Corporation, because it owned non-banking businesses.
Like insurance companies.
Primarily insurance, yes. And the principle here was simple. Banks should just do banking. They shouldn't be mixing depositors' funds with riskier non-financial businesses.
So the government forced BOFO to spin off Transamerica.
Yes, and this idea was later cemented into law with the Bank Holding Company Act of 1956. That separation was pivotal. It really confined BOFA's scope for a long time.
But the even bigger restriction was the one that contained them geographically. Regulators basically prohibited BOFA's interstate consumer banking.
This was the defining feature of American banking for decades. Banks were largely state-specific, and BOFA was, for all intents and purposes, a California-only consumer bank.
And the impact was immediate.
Oh, yeah. Domestic banks they owned outside of California had to be spun off into a completely separate company.
And that separate group eventually became First Interstate Bancorp.
Which is a great irony. First Interstate grew and grew and was eventually acquired by Wells Fargo in 1996.
So BOFA was forced to let go of its early national dreams, only to see its rivals benefit from the spun-off parts later on.
Exactly. For BOFA, the door to consumer banking outside California stayed pretty much sealed until the laws changed in the 1980s.
Wait, before we jump into the 80s, we have to talk about the massive technological disruption BOFA led while their physical growth was stuck.
The invention of the modern credit card.
Yes.
This is a fantastic example of innovation born from that Californian spirit. They were confined geographically, so BOFA looked for other ways to expand their financial influence. In 1958, they launched the BankAmerica.
What made the BankAmerica so revolutionary compared to, say, existing store cards?
It was a direct link to your bank account, and it provided revolving credit. You didn't have to pay it off in full every month. BOFA pioneered this by mailing unsolicited cards to residents in Fresno, California in a huge initial test.
I've heard that test was pretty risky.
Oh, very. The source notes they lost $8.8 million just in California from defaults on that initial mail-out. But that financial hit established the fundamental framework for the global electronic payment system we all use today.
And the final evolution of the BankAmerica card is something literally everyone listening uses.
That's right. By 1977, the BankAmerica card was officially renamed Visa.
Why the change?
Because while it was successful, international partners were a bit reluctant to issue a card still so closely associated with the Bank of America name. They feared it gave one competitor too much of a branding advantage.
So Visa became an independent network.
A multi-bank network, allowing for global scale. And at the same time, you saw the competition rise up. MasterCharge, which became MasterCard in 1979, Bolfer essentially invented the modern credit card landscape.
Okay, so those regulatory restraints on interstate banking finally start to crumble in the 1980s.
And that kicks off the M&A blitz that characterized Bolfer's next decade. The ability to expand geographically was like opening a floodgate. The return to M&A began in 1983 with the acquisition of Seafirst Corporation.
Seattle First National Bank.
Exactly. And this was an opportunistic purchase.
What was the opportunity?
Seafirst was technically insolvent. It was on the verge of federal seizure because of disastrously bad loans to the oil industry. By acquiring Seafirst, Bolfa gained an instant, major presence in the Pacific Northwest.
A critical move after being stuck in California for so long.
A huge move. They even kept the Seafirst name running locally for years to leverage its regional goodwill.
But it wasn't all smooth sailing. BOFA hit a big speed bump in the mid-'80s themselves, right?
Yes, huge losses from bad third-world loans. This made them vulnerable to a hostile takeover.
And the irony here is just delicious.
It really is. In 1987, BOFA faced a hostile takeover bid from First Interstate Bancorp. The very company born from the bank's BOFA had been forced to spin off decades earlier.
Wow.
They narrowly avoided it by selling off key assets, including their brokerage firm, Charles Schwab & Co., back to Mr. Schwab himself.
But by 1992, they had stabilized and were back on the warpath. They engaged in what was then the largest bank acquisition in history.
Security Pacific Corporation. That 1992 deal instantly gave them a huge coast-to-coast influence. It included Security Pacific's vast network across 5 western states, and it massively increased their dominance in California.
But the regulators were still watching closely.
Always. The Justice Department forced BOFA to sell off a chunk of Security Pacific's Washington operations to competitors. The goal was still to prevent too much market concentration in any one state.
Then came the move into the Midwest in 1994, acquiring Continental Illinois.
This was a brilliant move because of Continental Illinois' unique status. The federal government had basically been running that bank for almost a decade after it collapsed.
Because no one else could afford to bail it out.
Right. So acquiring it wasn't just buying a deposit base, it was establishing a key beachhead in the Midwest, where branch banking was still highly restricted.
So by the late 90s, BOFA was racing to become a full-service national financial firm, and that required investment banking.
Yes. That led to the expansion of BankAmerica Securities, or BAS. And to truly compete on Wall Street, they acquired Robertson Stephens, a specialized San Francisco investment bank focused on high tech, for $540 million in 1997.
So if we step back, the entire period from 1980 to 1998 was a race to dominate the U.S. map and diversify before the next crisis hit.
That's a perfect summary. They were positioning themselves to be a truly national, universal bank. But it left them highly exposed to global risks, which brings us to the next massive chapter.
The stage is now perfectly set for the creation of the modern giant. But ironically, the West Coast institution, the original Bank of America, had to go through a moment of real weakness to make it happen.
That moment was the 1998 Russian financial crisis. Bank America, as the California company was then known, suffered huge trading losses, and that made it deeply vulnerable to a takeover.
And that vulnerability was capitalized on by a very aggressive expansionist bank from Charlotte.
NationsBank. They acquired Bank America for $62 billion. And this transaction was, yet again, the largest bank acquisition in history at the time.
They just keep breaking that record.
It's a recurring theme.
So NationsBank bought Bank America, but the merged company took the more famous name, Bank of America Corporation. Why keep the name of the company you just acquired?
It was a brilliant branding move. NationsBank was the operational and financial survivor. They kept the Charlotte headquarters, which was cheaper than San Francisco. Hugh McCall, NationsBank's CEO, became the new CEO. They even kept NationsBank's stock price history.
But they took the name.
They took the name because of its unparalleled national and international recognition. It was the power of North Carolina operating under the famed California brand.
And the regulatory review for this massive merger was surprisingly smooth.
It cemented their dominance instantly. Post-merger, the combined Bank of America had $570 billion in assets and 4,800 branches in 22 states. And regulators only required them to sell off 13 tiny branches in New Mexico.
That's it.
A shockingly minimal concession. It suggests regulators at the time were very comfortable with large, stable national banks.
Hugh McCall stepped down in 2001, handing the reins to Ken Lewis. And Lewis inherited the machine and the playbook. If there's a hole in your business, fill it with a massive acquisition.
And Lewis executed that strategy masterfully. His first big play was in 2004, buying Fleet Boston Financial for $47 billion. This was crucial because it formally absorbed that ancient 1784 Massachusetts bank lineage,
Finally uniting the two historical roots.
under one corporate umbrella. And it instantly gave them dominance across New England.
He didn't stop there. He immediately turned to the booming credit card sector.
In 2005, Balfour announced the purchase of credit card giant MBNA for $35 billion. This wasn't just buying debt, it was buying market share and data. The deal instantly made both a leading credit card issuer globally, adding over 40 million U.S. accounts.
We also see them simplifying their global structure around this time.
That's the Latin American divestiture. They sold their operations in Brazil, Chile, and Uruguay to Banco Itaú in exchange for Itaú shares. It was an elegant way to reduce operational complexity while still keeping financial exposure to those growing markets.
And the acquisition pace just continued right up to the moment the financial crisis began to erupt. Two massive deals in 2007.
First was strengthening wealth management. They acquired U.S. Trust for $3.3 billion, adding $100 billion in assets under management.
And second, just as important for their regional footprint, was buying LaSalle Bank Corporation from ABN AMRO for $21 billion in October 2007.
That LaSalle deal was a strategic power grab, almost entirely focused on the Midwest. It instantly added hundreds of branches and over 1 million customers. And with that deal, BofA surpassed JPMorgan Chase to become the single largest bank by deposits in the Chicago market.
So these pre-crisis acquisitions positioned them for immense scale, but also immense exposure to the toxic assets that were about to detonate.
Unbeknownst to them, yes.
This era is the trial by fire for Bank of America. They absorbed risks on a scale that few corporations in history have ever attempted. And it's so critical for the learner to grasp how quickly that scale turned into systemic risk. It all starts with the acquisition of Countrywide Financial.
Countrywide was a troubled giant. BofA initially tried to stabilize it, but by January 2008, as the mortgage market was imploding, BofA announced the full purchase for a relatively cheap $4.1 billion.
What was the justification for buying this ticking time bomb?
It was pure dominance of the mortgage market, coupled with an attempt at systemic stabilization. The deal gave BofA control of 20 to 25% of the home loan market, and critically, Countrywide's enormous servicing portfolio,
9 million mortgages.
valued at $1.4 trillion. The thinking was that preventing Countrywide's bankruptcy was a strategic necessity for BofA's own mortgage business, despite the huge liabilities.
Wait a minute, you said the FBI was already investigating Countrywide for fraud when the deal was announced. How did management rationalize absorbing a company with known active federal fraud liability? Was that just hubris?
It was an unbelievably aggressive risk calculation. The servicing portfolio was seen as just too valuable to pass up, even if it meant absorbing litigation risk. And that risk became reality very quickly.
The December 2011 settlement.
A $335 million settlement with the Justice Department over discriminatory lending practices that happened at Countrywide between 2004 and 2008.
And what was the specific determination?
The federal probe found that Countrywide had systematically pushed qualified African American and Latino borrowers into subprime, higher interest rate loans, even when they qualified for prime rates. This was the dark reality of the liabilities BofA had just bought.
If Countrywide was a ticking time bomb, the acquisition of Merrill Lynch in September 2008 was the financial nuclear bomb.
It was an existential moment. Merrill Lynch, a pillar of Wall Street, was days away from collapse after Lehman Brothers went down. BofA rushed in, buying Merrill in an all-stock deal worth about $50 billion. The scale of this instantly made BofA the largest financial services company in the world.
It's fascinating that BofA was reportedly also talking to Lehman Brothers, but backed out because the government wouldn't offer guarantees.
And then they went ahead with Merrill. That decision was everything. The government, terrified of another collapse right after Lehman, provided the necessary support and pressure to make sure the Merrill deal closed.
Which brings us to the immediate, disastrous aftermath. The massive hidden losses at Merrill Lynch.
When BofA released its earnings in January 2009, the shock was palpable. Merrill Lynch had racked up $21.5 billion in undisclosed operating losses in just the last quarter of 2008.
BOFA's stock just plunged.
It fell so far that its market cap actually dropped below the price they had paid for Merrill just 4 months earlier. The market basically thought BofA was now worth less than zero.
This is what led to that explosive congressional testimony from CEO Kenneth Lewis, claiming federal officials pressured him to go through with the deal.
The pressure was unprecedented. Internal emails confirmed Lewis's account, citing a threat from the Richmond Fed president that if BofA backed out, the BofA management team would be gone.
So it wasn't just encouragement.
No, it was financial extortion, leveraged by regulators to prevent a systemic collapse. The government viewed the deal not as a business transaction, but as a critical national security measure.
But despite that initial horror, Merrill Lynch did eventually rebound and become a huge profit center.
That was the strategic justification that finally paid off. Merrill Lynch was fundamentally resilient, especially its wealth management network. By the first quarter of 2009, it was already generating most of BOFA's profit. The assets they bought, the people, the client list, were high quality. The acquisition, though disastrously timed, was financially shrewd in the long run.
Let's talk about the taxpayer intervention. The Troubled Asset Relief Program, or TARP.
BofA got an initial $25 billion in the fall of 2008. To complete the Merrill merger, they needed a second round in January 2009, another $20 billion, plus a crucial government guarantee on $118 billion in potential losses.
CEO Lewis claimed the bank was lending far more because of the TARP program, but Congress was very skeptical.
Intensely skeptical. The public perception was that the money was just propping up the banks, not flowing to the real economy. But BofA did move fast to get out of the program. They repaid the full $45 billion plus interest in December 2009.
How did they manage to repay $45 billion so quickly?
They used $26.2 billion of excess cash and, critically, $18.6 billion from their Tier 1 capital.
Can you define that for the learner?
Tier 1 capital is the core measure of a bank's financial strength. Using nearly $19 billion of their core capital meant BofA was willing to reduce its own safety cushion just to escape government oversight.
The regulatory fallout continued, though, peaking with that notorious bonus settlement case.
This was about the failure to disclose up to $5.8 billion in Merrill Lynch bonuses that were approved right before the merger vote. The SEC initially settled for a $33 million fine.
And this is where Judge Jed Rakoff stepped in, calling the settlement half-baked justice at best.
Rakoff's rejection was a landmark moment. He argued that the fine was a cynical deal. The shareholders who were harmed by the deceit were the ones who would ultimately pay the fine. He wanted to hold management accountable.
And a new settlement was reached.
A revised settlement of $150 million was reluctantly approved in 2010, ensuring the money went specifically to the harmed shareholders.
And beyond the Merrill scandal, BofA was hit with other fraud claims around this time.
Yes. In 2010, the U.S. government accused BofA of defrauding schools, hospitals, and local governments through misconduct in the municipal bond market. That resulted in a $137.7 million settlement. The sheer variety of the fraud claims just showed the massive internal control failures of that era.
And all this controversy ultimately led to the end of the Lewis era.
Ken Lewis retired at the end of 2009 amid intense pressure. Brian Moynihan became CEO in January 2010, ushering in the painful, necessary post-crisis era of shrinking the bank and settling litigation.
With Brian Moynihan at the helm, the strategy shifted profoundly. The era of relentless, multi-billion-dollar acquisitions was over. The new focus was internal.
Efficiency, risk management, and dramatically streamlining operations to save costs.
That operational shift was branded internally as Project New BAC.
Project New BAC was essentially a massive slimming down exercise. BofA committed to cutting an estimated 36,000 jobs to achieve $5 billion in annual savings by 2014. The cuts were brutal, but they were aimed at reducing the redundancy created by decades of mergers.
And this downsizing wasn't just about people. It was about reshaping their physical footprint and leaning into digital.
The physical branch network shrank dramatically. The number of retail branches dropped from over 6,000 before the crisis to under 4,500 by 2018. At the same time, they were pouring resources into their mobile app, and their active mobile users just exploded.
They also made a significant international exit, divesting their stake in China Construction Bank.
BofA had acquired a 9% stake in 2005 for $3 billion. But the post-crisis mantra was simplification and risk reduction. They sold off most of the stake in 2011 and were completely out by September 2013, a full retreat from direct involvement in China.
But despite all the cost-cutting, the biggest financial consequences of the crisis had yet to be paid. This all culminated in the record settlement in 2014.
That 2014 settlement was truly historic. It defined the sheer liability BofA had inherited. They agreed to a nearly $17 billion deal with the Justice Department over the sale of toxic mortgage-linked securities.
Mostly from Countrywide and Merrill Lynch.
Exactly. At the time, this was the largest settlement in U.S. corporate history with a single company.
Let's just pause on that number. They paid $4.1 billion for Countrywide, but the liabilities they absorbed cost them $17 billion in this one fine alone.
It completely shifts the risk calculation. It proves that the price of stabilization, the pressure to close those deals, came with a cost that dwarfed the initial purchase price. The $17 billion was broken into $9.65 billion in fines and $7 billion in direct relief to victims.
And it's important to note that the government's case relied heavily on whistleblowers.
Correct. The prosecution was heavily based on information from 3 whistleblowers who collectively received $170 million in awards. It highlights the vital role of internal accountability.
So once the legal liability stabilized and the cost-cutting was underway, BofA pivoted to a new growth strategy.
Organic expansion. Rather than buying massive banks, this was a critical shift. Starting around 2015, instead of buying a regional bank, BofA began methodically opening retail branches in new domestic markets where they previously had no presence.
So they were building from the ground up in new cities.
Exactly. They opened in Denver, Minneapolis, Indianapolis, going head-to-head with established local players.
And then into strategic markets like Pittsburgh and across Ohio.
The Pittsburgh move was a direct challenge to PNC. And in Ohio, they strategically entered Cleveland, Columbus, and Cincinnati, all strongholds of JP Morgan Chase and other regional banks.
And the organic growth strategy actually worked.
It did, especially in Ohio. Within just a year of entering Columbus, BofA became the 5th largest bank by deposits. It validates the post-crisis strategy. Instead of absorbing huge liabilities, they just leveraged their brand and technology to infiltrate new markets.
Finally, let's revisit the acquired assets that survived the crisis: investment banking and wealth management.
These are now the bedrock of the corporate business.
Yeah.
The investment banking division, now BofA Securities, remains a bulge bracket investment bank.
Could you quickly define bulge bracket for us?
Sure. The term bulge bracket just refers to the largest, most prestigious, and globally active investment banks, the firms that handle the biggest, most complex deals. BofA Securities sits firmly in that group.
And Merrill Lynch.
The wealth management unit, Merrill Lynch Wealth Management, is absolutely essential. It manages over $1 trillion in assets, making it the 2nd largest wealth manager in the world. The crisis acquisitions proved incredibly costly, but they also provided generational growth engines.
We've traced the history and absorbed the crisis, but for the learner looking at BofA today, we need to understand where the money actually comes from. It's remarkably focused, generating 90% of its revenues in the U.S. market, split across 4 massive divisions. The largest is consumer banking.
Consumer banking is the engine of the entire organization, responsible for about 38% of the company's total revenue. This is the retail face, the division that services everyday people and small businesses.
What's the full scope of services under that one umbrella?
It's vast. It's your traditional checking and savings, but also mortgages, small business loans, and merchant services. And crucially, it also integrates investment services through Merrill Edge.
And Merrill Edge is a key competitive tool, isn't it?
Absolutely. It's BofA's way of keeping customers who are moving beyond basic savings. It offers stockbroker services and investment research, competing directly with platforms like Schwab and Fidelity. It lets them maximize the revenue from each customer.
Moving on from the retail customer, the next big division is global banking.
Global banking accounts for about 22% of revenue. This is BofA's connection to mid-market and large corporations. This division focuses on commercial lending, treasury solutions, and specific investment banking services.
Where are they strongest in the competitive investment banking field?
Through BofA Securities, they are extremely strong in leveraged finance lending to companies with high debt loads, syndicated loans, and mortgage-backed securities.
The third major unit is Global Wealth and Investment Management, or GWIM.
Right, about 21% of revenue. This division manages the wealth of institutions and high net worth individuals. Its sheer scale just shows how profitable that Merrill Lynch acquisition was.
With over $2.5 trillion in client balances, what services are unique to this segment?
GWIM offers services that go far beyond basic investment advice. This is trust and estate planning, philanthropic advising, family office management. They aim to be a single point of financial management for families with significant wealth.
And finally, the smallest of the four core divisions by revenue is global markets.
Global markets is the sophisticated trading engine of the bank. It generates about 19% of revenue, but it's critical for providing liquidity and managing risk. This division serves institutional clients, hedge funds, pension funds, governments.
What are they actually doing in global markets?
They're engaged in trading financial securities, market making, and risk management using derivatives. Market making means they stand ready to buy or sell securities at any time, providing necessary liquidity to the market. It's a highly sophisticated, high-volume operation.
We have to end this deep dive by providing some detail on the persistent legal and ethical issues that really define Bank of America's modern identity. Its history is inseparable from this endless cycle of massive legal settlements and high-profile controversies.
It really is.
Let's start with some non-mortgage litigation, like the lawsuit from the collapse of the Italian food company Parmalat.
After Parmalat's huge bankruptcy in 2003, the company sued BofA for $10 billion. They alleged the bank profited from inside knowledge of Parmalat's financial problems. BofA eventually settled for $98.5 million in 2009.
But the shadow of the toxic mortgage business dominated the legal scene, leading to the Countrywide-related hustle scheme civil suit.
In 2012, the Justice Department filed a $1 billion civil lawsuit over the hustle scheme. It alleged that Countrywide had fraudulently sold thousands of toxic loans to Fannie Mae and Freddie Mac.
But that fraud finding was later overturned, wasn't it?
Yes. In 2016, an appeals court overturned it. They ruled the evidence only supported an intentional breach of contract, not outright fraud. It's a technical distinction that shows how incredibly hard it is for prosecutors to prove intent in these complex cases.
BofA was also a key player in that 2012 landmark industry settlement on mortgage abuses.
That was the National Mortgage Settlement. BofA was one of the 5 largest mortgage servicers involved. The settlement required the banks to provide about $26 billion in relief to distressed homeowners. It's still the second largest civil settlement in U.S. history.
And beyond mortgages, the Consumer Financial Protection Bureau, the CFPB, has repeatedly targeted BofA for its consumer-facing fees and services.
The CFPB has been relentless. In 2014, they ordered BofA to pay around $727 million in relief for illegal practices related to credit card add-on products.
What were they doing?
They were using deceptive marketing to charge 1.9 million customers for services, like identity theft protection, that they weren't actually receiving.
And that pattern continued right up to the present, with the massive 2023 CFPB action.
The 2023 action resulted in $250 million in fines and compensation for multiple deceptive practices. This included double charging insufficient funds fees, illegally withholding credit card rewards, and, critically, opening accounts without customer permission.
On the international front, BofA is still facing investigations for alleged market manipulation.
That's the ongoing South African rand manipulation case. BofA, along with other major global banks, is under investigation for alleged cartel conduct in the foreign currency exchange market, basically fixing prices.
Shifting to policy and ethics, BofA has taken some very public stances, especially on firearms manufacturing.
In April 2018, BofA announced they would stop providing financing to makers of military-style weapons, specifically referencing the AR-15 rifle. This was a notable corporate stance on a very charged political issue.
We also have to address the bizarre corporate paranoia around the 2010 WikiLeaks incident.
This incident revealed a fascinating level of corporate panic. Julian Assange claimed he had internal BofA documents and threatened to publish them.
So BofA proactively suspended fund transfers to WikiLeaks.
They did. But the preventative measures they took are what really stand out.
The domain names.
Let's pause on that. We're talking about one of the largest financial institutions in the world spending resources to buy over 300 negative domain names, including things like brianmoynihanblows.com, to preemptively control future bad publicity. It just shows a profound level of panic.
More seriously, there has been a recurring and highly charged controversy about debanking allegedly terminating accounts based on political or religious views.
This is a complex issue where corporate policy and public opinion collide. In 2023, BofA faced a shareholder action after the sudden, unexplained termination of a Christian charities account. More recently, former President Trump publicly accused CEO Brian Moynihan of political debanking.
BOFA denies it, but the recurrence of these incidents raises questions.
It does.
Another critical controversy involves customer privacy in the context of the January 6th incident.
After the events at the U.S. Capitol, BOFA was heavily criticized for reportedly handing over extensive private customer information to federal investigators.
This included shopping records and ATM usage.
Right. Critics accused the bank of being overzealous in handing over information, even though they were reportedly under no legal compulsion to do so. It just highlights the immense data surveillance power of a bank this size.
And finally, we have to acknowledge the intense internal culture, particularly in investment banking, which has led to some tragic incidents.
The culture of overwork has been under severe scrutiny. In 2013, an intern in the London office was found deceased after reportedly working until 6 a.m. for 3 straight days. This horrific incident sparked a major industry-wide debate.
And tragically, this was echoed more recently in 2024.
Leo Lukansas III, a former U.S. Army Special Forces veteran working in investment banking, died following heart problems. Internal reporting suggested the division fosters a culture of working over 100 hours a week, with managers allegedly pressuring employees to underreport their time. Lukansas had reportedly been trying to leave the firm because of the excessive hours. These incidents show the persistent human cost of that high-stakes culture.
Wow. We have traced a history that is really the history of modern American finance itself. We've seen Bank of America transform from Janney's revolutionary immigrant bank and the established Massachusetts bank through decades of massive acquisitions and technological innovation, like the birth of Visa, to the modern giant defined by that 1998 NationsBank merger.
An institution of perpetual motion.
And we've traced the harrowing path through the 2008 crisis, absorbing liabilities like Countrywide and Merrill, resulting in those record-breaking settlements, and reviewed the persistent tension between its global power and its legal and ethical controversies.
It's just a constant cycle of risk absorption and repositioning.
So what does this all mean for the learner looking at this multi-trillion-dollar entity today?
Well, Bank of America operates today as a core financial infrastructure for the U.S. and the world. It's massive in scope, deeply integrated across every part of finance. What's fascinating is the continuous tension that defines it.
Yeah.
How does a company whose legal foundation traces back to a 1904 philosophy of serving the underserved, how does it reconcile that legacy with being a systemically important global firm, frequently subject to massive government fines over consumer harm and deceptive practices?
Indeed. The history of Bank of America is arguably the history of American banking regulation itself, an endless cycle of expansion, consolidation, crisis, legislative response, and then finding new ways to expand again. So given its status and the recurrence of these controversies, the question for you, the learner, is this. Does the sheer size and global importance of an institution like Bank of America inherently make consistent regulatory compliance an impossibility, or does their market dominance simply grant them the economic resilience to absorb multi-billion-dollar penalties as a manageable, inevitable cost of doing business?